40% of the planet's wealth? In a world where 34,000 children die every single day from poverty and preventable diseases, and where 50% of the world's population lives on less than $2 a day, one thing is clear: something is very wrong. And whether we are aware of it or not, the lifeblood of all of our established institutions, and thus society itself, is money. Therefore, understanding this institution of monetary policy is critical to understanding why our lives are the way they are. Unfortunately, economics is often viewed with confusion and boredom. Endless streams of financial jargon coupled with intimidating mathematics quickly deters people from attempts at understanding it. However, the fact is, the complexity associated with the financial system is a mere mask, designed to conceal one of the most socially paralyzing structures humanity has ever endured. A number of years ago, the Central Bank of the United States, the Federal Reserve, produced a document entitled Modern Money Mechanics. This publication detailed the institutionalized practice of money creation as utilized by the Federal Reserve and the web of global commercial banks it supports. On the opening page, the document states its objective. The purpose of this booklet is to describe the basic process of money creation in a fractional reserve banking system. It then proceeds to describe this fractional reserve process through various banking terminology, a translation of which goes something like this. The United States government decides it needs some money, so it calls up the Federal Reserve and requests, say, $10 billion. The Fed replies, saying, sure, we'll buy $10 billion in government bonds from you. So the government takes some pieces of paper, paints some official-looking designs on them, and calls them Treasury bonds. Then it puts a value on these bonds to the sum of $10 billion and sends them over to the Fed. In turn, the people at the Fed draw up a bunch of impressive pieces of paper themselves, only this time calling them Federal Reserve notes, also designating a value of $10 billion to the Fed. The Fed then takes these notes and trades them for the bonds. Once this exchange is complete, the government then takes the $10 billion in Federal Reserve notes and deposits it into a bank account. And upon this deposit, the paper notes officially become legal tender money, adding $10 billion to the U.S. money supply. And there it is. $10 billion in new money has been created. Of course, this example is a generalization, for, in reality, this transaction would occur electronically, with no paper used at all. In fact, only 3% of the U.S. money supply exists in physical currency. The other 97% essentially exists in computers alone. Now, government bonds are, by design, instruments of debt, and when the Fed purchases these bonds, with money it essentially created out of thin air, the government is actually promising to pay back that money to the Fed. In other words, the money was created out of debt. This mind-numbing paradox of how money or value can be created out of debt or a liability will become more clear as we further this exercise. So, the exchange has been made and now $10 billion sits in a commercial bank account. Here's where it gets really interesting. For as based on the fractional reserve practice, that $10 billion deposit instantly becomes part of the bank's reserves, just as all deposits do. And regarding reserve requirements, as stated in modern money mechanics, a bank must maintain legally required reserves equal to a prescribed percentage of its deposits. It then quantifies this by stating, under current regulations, the reserve requirement against most transaction accounts is 10%. This means that with a $10 billion deposit, 10%, or $1 billion, is held as the required reserve, while the other $9 billion is considered an excessive reserve and can be used as the basis for new loans. Now, it is logical to assume that this $9 billion is literally coming out of the existing $10 billion deposit. However, this is actually not the case. What really happens is that the $9 billion is simply created out of thin air on top of the existing $10 billion deposit. This is how the money supply is expanded. As stated in Modern Money Mechanics, of course they, the banks, do not really pay out loans from the money they receive as deposits. If they did this, no additional money would be created. What they do when they make loans is to accept promissory notes, loan contracts, in exchange for credits, money, to the borrower's transaction accounts. In other words, the $9 billion can be created out of nothing simply because there is a demand for such a loan and that there is a $10 billion deposit to satisfy the reserve requirements. Now, let's assume that somebody walks into this bank and borrows the newly available $9 billion. They will then most likely take that money and deposit it into their own bank account. The process then repeats, for that deposit becomes part of the bank's reserves. 10% is isolated, and in turn 90% of the $9 billion, or $8.1 billion, is now available as newly created money for more loans. And, of course, that 8.1 can be loaned out and redeposited, creating an additional 7.2 billion.